one one little store. 4.7 million.
Oh my goodness.
Yes.
Wow. For how many students are in that school district, you know?
I don't know how many, I can't remember, but to the
Okay.
Pelmac school district.
Yeah, yeah. No, absolutely. No, it'd be interesting to see like a per student count. Yeah, I would suspect like out in like more of a rural area, that'd be a thing. So, all right, well, we are live streaming everybody. Tonight we are going to talk about a hot topic as of late by popular demand is partnerships. Okay, there's a lot of people that are in this group that have partnered on deals and scaled as a result of that, scaled quite dramatically, far faster and farther than I would have ever imagined. Yeah, I wanted to go into that and kind of like general framework as to how I think about partnerships. I mean, I spent the first probably 11, 12 years doing everything on my own as the sole person. And then I, heard a quote that stuck with me, and that if you want to go fast, go on your own. If you want to go far, go together. So we're gonna talk about that tonight in different structures, how to find the right partner, roles and responsibilities. Generally, what I use as a when I'm forming partnerships, and also setting expectations as well, for yourself and also for the people that you partner with. So that being said, also we're going to have a Ryan Van Hoover, I think, coming on tonight. That's going to talk about a little bit about his experience with partnerships. Uh, just to kind of preface this whole thing, also, if you, for any of you who have been asking about partnerships, we're going to the different themes of those tonight. But pop a question in the chat so we can address those questions. Okay. Um, that being said, um, the reason why I partnered, okay, originally after being scared of partnerships, because the thing is that I've always heard, and probably I don't know who's ever heard here, that like partnerships are bad. Everything is like gone to hell in a handbasket when anybody's ever partnered before. Um, and that is really something that I was indoctrinated with, and I avoided it like the plague during most of my career. So during the first like 11, 12 years. So, oh, this is actually Ryan right here. Oh, he's trying to get on. Here, let me text him the Zoom link real quick. I don't know, Vlad. While I'm texting Ryan the Zoom link, I don't know. When did you start partnering? And I don't know. I guess anything for that matter, or like were you doing stuff on your own for the most part?
Sure. No, I've always partnered. I don't like doing anything on my own. I started several businesses with partners, and then in my teenage years, and then when I got into real estate, the only I only bought a handful of properties alone on my own, and they were from 18 until 20. So at 20, I met Anton, who's still my partner till today. Um, Anton and I have been 50-50 in all of our ventures. Everything, which is almost 2 dozen different companies of all sorts of services, trades, and you name it. But including real estate, literally every deal. I don't own a single thing on my own. Everything is in a partnership.
Yeah, absolutely. Well, yeah. So Ryan Van Hoover got in here. Ryan, welcome back, man. It's been a long time. How you doing, Dad? Ryan's a father of a how old baby girl, right? Hold on a second. You gotta unmute yourself, brother.
What's going on, guys? My daughter is 4 months tomorrow, so it's a journey, but it's a good journey.
It's a spiritual journey. Um,
It is.
so
It is.
before we get into the meat and potatoes of this thing, I kind of want to like add some lived experiences to like partnerships and real estate deals and other ventures. It doesn't necessarily need to be real estate. But what's been your experience with partnerships and what you've learned, during your history and as an entrepreneur, whether real estate or otherwise?
So I've had some good ones and I've had some bad ones. I've been recently learning a lot more about the bad ones. Um, but you live and learn. It's very difficult to try to unravel things with a bad partnership. But I've learned the recent deal I did at Hudson, they're some pretty smart guys. Obviously, I've done a lot of partnerships with a lot of different people in different areas. And I thought they were going overboard, but they really weren't. I mean, we covered details from divorce because I was going through one, but also like death. You don't think about those things, but if you have partners, they die, you know, you got to have something in place to try to figure all that stuff out versus, you know, letting someone else figure it out for you. So, but, you know, when you have a bad partner, it's, we're a partner that's not, I wouldn't say bad, not on the same line as you, or same thought. You kind of, you know, break away and your concentration breaks, and it's very difficult to get back to the focus. So I've learned a lot from a bad partnership versus a good partnership. So
Well, I already got some questions in the chat here, Ryan. So, and this is actually pertinent to like what you went through through the, through basically you were partners with somebody else when I onboarded you into Go Bigger Sooner back a couple years ago. I guess what warning signs, and I want everybody else to chime into this that have actually like put together ownership groups for real estate deals. But what warning signs do you now recognize you missed before entering a partnership?
probably, just a different vision, different mindset, different focus, but really comes down to the mindset. When someone's not thinking how you are and having the same vision, you kind of just, you know, spread apart, and, then you kind of butt heads, and it's not cohesive, and it's hard, you know. You got to be on the same page. And I feel up front, you have to lay all that out. And we didn't. We kind of just kept going, didn't have any ground rules or, divided responsibilities. And you kind of just wing it, which, you know, is not what you want to do. But when you get started, it's fun. But at the end of the day, it's a business, and it wasn't getting treated like that. So um, it was definitely a learning experience.
Yeah, so yeah, if I can kind of add to that, so it's like why partner to begin with, right? And this is like my my philosophy. And the worst partnerships I've had four failed partnerships in my career, all on real estate related stuff. And the thing is that um I found that the ones I got into that were didn't work out, and whether it was my some of the stuff was my fault, and some of it was not my fault, right? And the thing that you have to go into that I've learned for this whole experience is that one, there's a common vision in terms of what you want to do. Okay, so I've been in partnerships before, like one of my first ones where I was looking creating long-term wealth. Okay, like long-term wealth, not necessarily cash flow, but like actually like reinvesting profits back into the business and growing. And this first partner was like about taking distribution, like wanting to take distributions out of the business and really not scale, like not thinking long term, right? Thinking about as like they thought of like real estate as cash flow. And for me, it was a long-term wealth creation and also intergenerational wealth creation too. So having that alignment of vision is really important. The most recent partnership that I had in terms of like a 50-50 partnership. Now I've put together ownership groups where I have passive investors that come into a deal that own a certain amount of equity in the deal, and they're truly passive. Okay, but my partnership with David Martin, right? We took things really slow because I'd been through four failed partnerships that were pretty difficult to unravel prior to that. And so I wanted to like really take my time in terms of like dating this person. Okay, and we met at a coffee shop every single Tuesday at 10 a.m. I think for probably, God, I think it was probably 10 weeks. All right. And we put and first thing that we did is we put together an agenda. We spent an hour together each time, kind of going, I was like, all right, what is the vision? Like, what is the vision you see for yourself? What are your values as well? Okay. Because I think that even though we're going to go into like roles and responsibilities in this, but if you don't have the same values, that is like the sort of the nucleus of the whole thing that makes it work. All right. Um, and the thing is going to fall apart. I can work around everything else, but the actual values. When I don't have that alignment, all right, and also every single failed partnership I've got involved with has been out of desperation, pretty much. Okay, it's like I don't have the money for a deal. Or one in particular, there was a 28 unit apartment building that was a major wreck that I renovated. I was completely overwhelmed by the rehabilitation of the property. And I was in a moment of weakness. I brought in a GC that had done a general contractor, had done a couple of projects for me before, just to get a quote on getting the whole project off the ground, because I had always GC'd projects myself, but nothing to the extent of this scale. And I was such in a moment of pain on this whole thing and fear that when they walked through, it's like, hey, I can give you a quote on this whole thing, but why don't we partner? We'll have an alignment of interest. Okay. I didn't take my time. I didn't take my time. I was just in that moment of desperation, and that's the times that I've always gotten into bad arrangements from a partnership standpoint from the beginning. Um, Anybody else have anything to add to warning signs or things like that? Maybe not even warning signs, but questions that you've asked before getting involved with a partnership with a business partner or a real estate partner.
I can
So I'll
speak from
say one
being.
more thing
Okay.
that I learned doing the last deal I did with the partners I have, and it was kind of simple, but they don't need um, as far as money, they don't need the money, and they're not hovering over me, so it's uh, kind of peaceful to kind of do what you got to do, and they're not hounding you, looking over you, not like asking, where's my money? Where's this? They trust you. They know you're going to do a good job, um, and execute on the plan. It definitely makes it easier with partners like that.
Yeah, Matt Bain, you were going to say something.
Yeah, I was gonna lean into the comment that you made as far as values. That looking backward at previous partnerships, I know now that I need to focus in on aligning values, as you mentioned. That was a huge, I think I'd say disconnect. That I learned that lesson for sure. So just reiterating what you mentioned.
Yeah, and then Vlad, anything you got to add to that?
Yeah, so when I look at partners, or besides the character, and I think what I consider the foundation, the trust, and their work ethics, and the alignment of goals, that's the most important part. If you don't have all of that, then you can't even advance further. Like, this is a deal breaker. Like, these are non-negotiables. Um, if you have somebody who's chasing fast money and wants to turn a lot of properties and go into one direction while the other one has a long-term strategy in mind, that's you're asking for conflict. So having a business plan is a must, and discussing that, what a 5 year horizon looks like and a 10 year horizon looks like. Um, Also, lifestyles are also very important. I've had um, issues in previous partnerships where um, my partners weren't okay reinvesting as much capital into the business when they had a significant lifestyle to upkeep, and the goal was to bleed the business dry every quarter. And that's frustrating when I would reinvest my shares. So like all these things are important, but also uh, at the end of the day, like what is this partner doing for you, and what is the partner doing for the business? And it's got to be bringing in something that, in my opinion, the business can't survive or operate without. Like that's the missing link. Because if you can do it without that partner, then you should just do it without that partner because um, like the strategy of using partners is, I think, very beneficial if you want to scale for so many reasons. But your partner's got to be doing something that you're not good at, and that's the simplest way I can explain it. That's what's been successful for me is my partners let me do what I'm good at, and I can step away from the things that I'm maybe before had to do because out of a necessity. But if everyone focuses on their good attributes and their skills, um, and there's, like Ryan said, there's trust that everyone does their component honestly and fairly and to the quality that is also, that's another one mutually agreed on. I had a scenario where I had a partner who was a perfectionist and wanted everything done to 110% in a business that wasn't this wasn't real estate, but in a business that doesn't ever get to 100%. And if any of you know my personality, I don't do anything to 100%. I'm like 92 is good enough, but I would do a lot. I go for volume, but like if I can get it to in the 90s, it's good. Um, but I had a partner who kept pushing me to do above and beyond where it wasn't necessary, reinvesting money and energy into things that could look perfect to, but wouldn't really do anything for the business. So we kept butting heads just on the style of, I think maybe a personality trait there. So not all of my failed partnerships were bad. The worst one cost me $250,000, but a lot of them we're still friends with, and we just didn't work out in alignment of goals. Um, Whether I had a partner that, a year into our business decided that wanted to move out of state. And it turns out that there was a red flag because they've been planning on that for a long time. And I wouldn't have chosen them as a partner had I known all these things ahead of time. So um, getting to know someone is crucial. I mean, it's very much like dating, I would say. Um, and then it's very much like marriage, but if you do it right, like with a prenup, so everything is spelled out, and there's all these contingencies in place. Um, a buy sell policy, I think, is important, and so that you have these situations where if someone dies or someone uh, can't run their business anymore, so there's a mechanism for a buyout. Um, so these things are absolutely important. We have several insurance policies, and um, ironically, I asked my partners to jump on tonight, and it turns out that they're either on boats or fancy dinners tonight. So none of them are here, unless Joe is. He didn't respond. Maybe Joe will chime in and talk about our partnership as well if he's here. But oh, you're
Oh,
driving.
yeah, he's driving.
Hey, Vlad, I got a question for you.
Shoot.
Some time ago, you had mentioned uh, when you were establishing the group that you have now, that you sat in front of an attorney that kind of ran you through the gamut of types of questions and things that you'd run into. I know it was
Hmm.
probably for the operating agreement, but
Yeah.
can you share some of those some of those questions or topics?
Yeah. So we did in this partnership, our actually Joe's friend we had retained a consultant who is an attorney specialist with structures and corporate structures was his expertise. The kind of questions they asked is, it's all of the what ifs that you can think of. But operationally, who's going to take over for who? If in the event if one of the partner wants to get bought out, if what that looks like, and one of the partner wants to leave, if we want to bring in additional partners, what does that look like? What happens if we want to sell a property or buy a new one? Major decisions, all these things are negotiated, and who has what kind of voting rights and such as that. Joe, can you remember any specific, like any weird concerning questions?
I think you covered most of them. I think just some of the ones that are just good to have written down if you don't think they're going to happen. Like, again, like what happens when a partner dies?
Mm-hmm.
Can their heirs just step in all of a sudden? Their kid or their nephew is now your partner, or do they automatically get bought out? What does that process look like? Does it involve an appraisal of the properties? Is there agreed upon buyout of their shares? What happens if there's a decision that needs to be made, and you've got four partners and it's 2 against 2? How do you do the tiebreaker? So all that stuff is, you just want it up right now. And one thing we asked them is, what are the things we're not thinking of?
Mm-hmm.
Because the person we were using, he does a lot of these agreements. So he's kind of like, well, here's like your A, B, and C options of how to address this hypothetical, and then we just kind of got together and we talked about what we thought was best for us. Another option that they gave us was you can go like really specific with how you want to do your partner, as far as like what roles are, for example. Like this is this person's very specific role. This is this person's very specific role. We shied away from that a little bit. We decided, we discussed it amongst ourselves, and Vlad kind of talked about that a little bit, of kind of identifying among partnerships, but we opted not to have it be that rigid within the operating agreement.
Yep. Yeah, a lot of succession planning in general. If you don't have it personally with what you already own, you probably should, because that will come into some decision making when it's time to partner with someone. So the succession planning is something we all should be thinking about, but it comes important in a business plan. But I just had another idea, but I lost it.
Vlad, interrupt me. I was looking totally at my screen. Christina Adolf Monero, why don't you unmute yourself and introduce yourself here? I know I introduced you on the Facebook group, so come on here. Tell us a little bit about yourself and what your goals are.
I can't just fly under the radar over here.
No, you cannot.
Okay, hi everyone. I'm a full-time real estate agent of 19 years, I think. I'm a mom of 2 boys, 10 and 15, and I am here local in Rochester. And I have just a handful of residential rentals. So I have 1 duplex and 3 single families, and I'm looking to go bigger.
I'll stay with the game. Well, yeah. Well, welcome, and yeah, and certainly, yeah, we got your updated folder. So yeah, just continue going through like the onboarding module there, and look forward to having our first one-on-one onboarding call with you. Okay.
Yeah, thanks, Matt. I'll get it taken care of this week. Thank you.
Okay. Now we're kind of talking about 2 categories here, right? Because Matt Bain is talking about kind of like an active partnerships, right? Where there's actually members of the company that are performing like active like day-to-day tasks with the actual company. And then I do want to get into to the other kind of like bucket of partnerships, which is like the more money partnerships, which Mike Fresky's actually popped some questions in the chat as well. But kind of to like recap as we've talked so far is like is alignment of goals, alignment of values, okay, and then also just taking your time and not being too quick. Every single failed partnership that I've got involved with, it just happened way too fast. So it was deliberately, David and I were deliberately slow and kind of dating each other over this, and we did this before we even had an operating agreement signed. Okay, we didn't have any of that. We just had like a basic like outline skeleton of what we saw, right? Because my objective at that point in time was to fire myself out of the management operations for my portfolio at the time. All right, so our roles and responsibilities are very very clearly defined, right? So David manages all the day-to-day operations for the entire company, the property management functions, the bookkeeping, the leasing, the repairs, managing the repairs and maintenance teams, that sort of thing. And my sole role is the business development, right? But building relationships with capital partners, building relationships with brokers, city officials, just being out there, right? This is the reason why I have the time to dedicate so much time to, like, let's say, doing marketing and social media and that sort of thing, right? So, another way to sort of date before you get married in a partnership is, and I love doing this, is that if there's somebody that really wants to, we're talking about potentially partnering in the future, right? In an active role, not a passive role, but an active role, is doing something that we can collaborate with each other on, like some sort of project. Okay. Because there's got to be some sort of like, after you've gotten to know somebody, there's got to be something like in terms of like a common ground in terms of interest, right? So for me, I mean, I love local politics. Okay, I've done a lot of fundraising stuff there. So like one of the ways I like to actually, collaborate with somebody is it's like, hey, let's meet this potential candidate, vet them. If you like them and I like them, let's collaborate on doing a fundraiser together. Okay. This is just one example, right? So then I can see, okay, how does this person operate? How does this, what type of initiative does this person take? How much ownership do they take over the tasks that they've been, that they've promised themselves and to me on this thing? Or do they show up on time? Do they do what they say they're going to do? They say you're going to do. Do they also take ownership when they actually make a mistake on something, right? So you can do these things with active partners, and this could be something if you're on a doing a fundraiser for a nonprofit, for instance. You're looking for help, or you're looking to help somebody else in that venture. So it doesn't necessarily need to be like you can start working with this person, start dating them before you get married to them, right? And I strongly recommend doing that, because you can talk at hypotheticals, going to down by line by line down to like alignment of goals and the roles and responsibilities and that sort of thing. But if you haven't like seen how this person operates, like actually in action, not just through their words but through their actions, and having alignment there, then you're probably going to set yourself up for disappointment or surprise later on. So, in terms of roles and responsibilities, okay. So we have, and I know Matt touched on this with one of his questions, but you have four real, I guess, bottlenecks or constraints, and everybody has these things, right? It's capital, it's experience, it's time, and it is relationships. Okay, and so that is one thing that partnerships can actually be really great at, right? Because all of us have our own respective spheres of influence with our relationships that we've worked on, whether intentionally, unintentionally, for sometimes decades in this room. So being able to actually transfer that trust, whether it's a capital partner, I know some of you have actually in your partnership groups brought in capital partners, like strictly just money partners in some of the real estate deals that you've done. And that may not be possible if that other person in the partnership group didn't have that relationship, right? Um, and so rarely does one person possess all four of those things. But I'm always going to look for some type of for time. I knew that my wife and I wanted to have kids. This is when I was like looking to fire myself from from being a property manager and wearing all the hats, that sort of thing. So that was one thing, is that in my dating with David, his pain point is that the how he was making his money at the time, his active income was through fixing and flipping houses, and he was sick of it. He didn't want to do it anymore. Okay, so I had an opportunity for myself to free up my time, because he had the time, because he didn't want to spend it on fixing and flipping houses. He wanted to, he was at least open to it at the time as handling the property management operations for the company, right? So there's always got to have this, at least in my opinion, okay, and everybody has a different opinion. There's always got to be some sort of like yin and yang. Okay, what David does is extremely detail oriented. He's very super analytical. He's like he drives me nuts sometimes in terms of like how detail oriented is. Okay, where I'm the cowboy. Okay, I'll just like jump into things just because of my feeling. Okay, and so we have this like yin yang, not only from a skill set but also a personality standpoint, that's led to like a very strong partnership in our world. The other thing too is that when you start to before anything, okay, strength, one of the constraints, right, is capital. Okay, I will always at some point in time, before we get serious about then actually hiring an attorney to negotiate an operating agreement for a partnership, I want us to open up our kimonos to each other and seeing what type of cash do you have, what type of assets do you have, what type of liabilities do you have. Okay, I want to have that transparency, so I know that, okay, I'm heavy on cash. My partner is heavy on equity in the real estate that he owns, or whatever. So that I know exactly what I'm going into. Because the thing is that when you are, you're going to have times in your partnership, really successful ones, and ones that are just mediocre, where the business is going to require cash that is not in the account. Okay, and you're going to have what's called a capital call with the ownership group. All right, so if you're partnered with somebody that doesn't have that much cash at all, and you have a capital call, that all right, I mean, I don't know if this person's actually going to be able to perform on that. Okay, so knowing that right up front, and also just having the expectations, right? So for myself, with capital calls can be a few different things. Okay, so most of what we do is we don't have a capital call. Well, let's define what a capital call is, right? So you run out of money, and I don't know, Daniel, I'd love for you to chime in here too, because you've done some partnership deals in the past too, non-real estate related stuff. But what happens when the business needs money? All right, the boiler blew up on your apartment building, and you don't have enough money in the bank account to cover it. All right, so you can do a capital call where you're basically giving a notice to all the owners, all the members of the LLC that are in there, and saying, hey, we have a $50,000 boiler that needs to be replaced. We need to call in capital pro rata based upon each person's membership interest in a group. Okay, and if they don't respond to that capital call, vis-a-vis putting the actual money into the account to respond to that capital call, then they can get their membership interest can get diluted down at that point in time. Now, I've only had to do that once. Typically, what we do is we do partnership loans. Okay, and in the operating agreement, I actually have spelled out, okay, if a partner is making a loan to the partnership, what does that look like in terms of like the interest rate, how it gets paid back, when it gets paid back, and all that sort of thing. Okay, and that's usually what I like to do in terms of like that, because I've had deals where I've had partners that are even minority partners that are whales. Okay, for instance, we had a building where the elevator went down. We had to modernize it. It was a $275,000 job. Okay, we had, I think, $60,000 in the operating account. All right, so we sent an email out to the ownership group and we said, hey, we have a need for $275,000. We're going to be refinancing the property, but in about a year and a half. We're offering out 10% interest only, while the capital is in here and that sort of thing, right? And so that minority partner, because he had a lot of cash, ponied up the cash to do that. So there's various mechanisms that can be spelled out in the operating agreements. Okay, and that's the reason why it's great to actually have equity partners in a real estate deal. And it's because the thing is that there's more of an alignment of like, hey, we're in this together, rather than when I've had private money lenders that have fronted, like, let's say, the down payment and closing costs for a deal, and I'm going to them and say, hey, listen, Jonathan, we need $275,000 to modernize the elevator in this building. Typically those money lenders have been like, hey, you know what, I'm not expanding my exposure into this thing anymore. And typically I've had them say no. All right. Whereas an equity partner that actually has the cash, they're like, okay, hey, I have long-term ownership interest in this deal, so I'm actually gonna, yeah, I'll do it. I got the money, and I'll do this. And as long as I'm getting paid back in a year and a half or whatever, we've done that before as well. So, um, so Daniel, tell us about your experience with partnerships and kind of like, because I'm really curious because you've been in stuff that's like, I guess, real estate adjacent, but not like real estate investing before, and how you've thought about partnerships and all that good stuff.
Yeah, everything that you guys are saying tonight is absolutely spot on. It's resonating for me pretty sharply. I got into almost everything I've done, with the exception of real estate, has been partnership. Um, I got into a three-way partnership with two very old friends for a millwork company, and we took out a private loan, um, interest only for the first 3 years, about $250,000 to get our company up and off the ground. That got us into a 10,000 square foot building. It allowed us to buy a CNC machine, which we knew that we were going to need, and it also bought us operating capital until we were sort of solvent with booked work. We paid ourselves peanuts, but we still had to operate the place, pay the utilities, pay the employees, and really pound the pavement for the next jobs that were going to feed us and stop the bleeding. Um, we never had occasion um, to have to borrow money from one another. We were always able to go to small banks and get lines of credit and leverage those lines of credit for the occasional capital expenditure that we needed. Um, as we grew, we ended up in partnership with a whale who was very generous in terms of not diluting us down to zero when we sort of merged his existing company that he was looking for new leadership for with our company, which was humming along, but sort of humming along at a size and a scale that wasn't liable to grow exponentially in an organic fashion. So, he kind of made us an offer that we couldn't refuse. And in turn, we salvaged his foundering business, put everybody under one roof, and combined the revenue streams of both businesses. And then from there, when we needed capital that we didn't immediately have, we no longer had to go to small banks. We just went to Daddy Warbucks, so to speak. But Daddy Warbucks wants to be paid back with interest. I can't remember who said it, but it is helpful to have one partner who has money and isn't in urgent need of seeing it returned. It allows you to structure that repayment plan in a rational way, that doesn't apply too much pressure to the business, and with a partner who could afford the loss if he had to take it theoretically, but isn't, breathing down your neck for it, and coming to you every other month with an excuse why he may need to withdraw his funds early. So yeah, I can't speak too much to how to get creative on, or diluting membership. I will say there was one instance, and this whole thing was a bit of a boondoggle, but as we recognized several years into the business that we are a service-based business, and it's hard to build equity, uh, uh, brand equity, business equity into a service-based business, we started looking around for other investment opportunities. We stumbled upon a microbrewery that was brewing fantastic beer. We were all beer drinkers. You know where the story goes from there. And as luck would have it, the founder of that microbrewery, fantastic brewer, like incredible brewmaster, but didn't have two nickels to rub together, which is why it made sense for him to allow us to come in, buy our way into his business, and then become equity stakeholders. In that business, and on a much smaller scale than the millwork business, when we did need a capital call, the three out of the four of us did put our own money in, and then diluted him down accordingly. And it was all, very amicable, very rational. We stepped through it slowly. We made sure everybody was happy, but it happened two or three times. And the trouble with that, and we didn't realize it until it was too late, but you do dilute a partner down low enough, and they lose their motivation, they lose their incentive to participate in the partnership anymore. And so it wasn't quite that cut and dried. But when he announced his departure from the business, we didn't really have much we weren't able to offer him much incentive to stay on. And so that left us scrambling to find a new brewmaster. And the one we found was competent, but not nearly of the caliber that the original was. So that was a lesson learned there. And then just speaking specifically to real estate, this is just a personal anecdote, but I've always treated my real estate portfolio as something separate from my partnership businesses. And so everything I've done has been by myself. But as we've spoken about at length, Matt, there's a ceiling to that, right? Eventually we all run out of our own money. And at that point, you have to get creative and start to lean on folks. And that is where so much of the wisdom that's been imparted so far tonight, has really been relevant and resonating for me, in that when I started my partnership on the millwork business, we were young, we were ambitious, we were best buds already, and that was good enough to get going. We had a joke of a business plan, but what we had was a lot of talent. We had synergistic skills. We had a Rolodex that we knew that we could count on, and we were young enough that we were willing to take a flyer on this whole endeavor. That was 15 years ago. We're older. Priorities change, perspective changes. Some folks want to treat it like a personal piggy bank. Some people want to build for long-term investment. And yeah, lifestyle alignment, all that kind of stuff does end up coming to play. If not today, it will tomorrow. And so that stuff really ought to be thought about and thought through. I am an advocate for keeping the operating agreements fairly lightweight. At the end of the day, you know, we're not trying to build a multinational corporation, so people's roles and responsibilities don't have to be defined within an inch of their life within that operating agreement. But exit strategies do, succession plans do, all that stuff is very germane to any partnership, and it would behoove you not to rush through that process.
Absolutely. Daniel, thank you so much. Yeah, and I do want to get to do want to get to Mike's side of like the money partner type of thing and that sort of thing. So, um, but the exit, the exit strategy or the exit plan, because the one thing that Vlad touched on was having a prenuptial agreement before getting into a partnership spelled out in the operating agreement. So after you get an actual like the fundamental kind of terms, like the roles, responsibilities, the alignment of the goals and values, and that sort of thing. Okay, the making sure that your prospective operating active partner doesn't have a huge lifestyle desire, right? Um, is then it starts with the operating agreement, right? And so I think the best way to do this, the most effective way, is getting into a room with with an attorney, okay, that is experienced on this, just like Vlad and Joe and Todd and Anton and Orlando did with the Acorn Collective, right? Because then that's the most efficient way of doing it. And also like asking that question of like, all right, what are we not thinking about? Okay, that should be in this thing. So the exit strategy, right? I mean, this is how I have it spelled out in all of my active operating partnerships. It's beautifully simple. Okay, you come to a disagreement or you need to like exit the partnership for one reason or another. And so you have what's called a buyout that's spelled in the actual operating agreement. The one I've always had is that if you want to get bought out, okay, or you want to buy out to the other partner when you get to fundamental disagreement that you can't get past, is um, is you make an offer to the other partner for the business. Okay. Now that offer that you make in writing, they can also accept that offer, and you have to accept the terms of that offer. Okay. So if you make an offer to your partner and say, "Hi, I want to buy you out for $1," and the other partner's equity is worth $1,000,000, then they can turn around and say, "Okay, I'll buy you out for $1." Okay. So there's kind of like this. I don't know if it's the law of like mutually assured destruction from doing something that's like that's not um, was it that might be like disingenuous. Okay. So thinking really really hard about that, so you make an offer to the other partner that's fair. Okay. That's how we have that structured on the actual exit. There's a number of different things we can go into this, but like the first steps, like there's a lot that goes into it before you even meet with with an attorney. Okay. And the thing is that um, you don't need to actually have an operating agreement to establish, especially for like for real estate deals, until you actually have a deal a deal under contract that you've gone through due diligence and all that stuff. Okay, so with our partnership that we did, God, on a deal we closed like 6 or 7 months ago. We had the fundamental terms and conditions of the partnership, and then we had it memorialized after we went through due diligence and knew we were going to do the last deal that we did. Okay, so it's not something that you have to like actually, if you have a new partnership and you're going out there, it's like, hey, we want to buy industrial buildings between 10 to 50,000 square feet. Let's go see an attorney and get an operating agreement established. The reason why you don't want to do that is because let's say you don't find a deal this year, okay, and you have a partnership that's going to have a partnership return that's due on some company that hasn't done anything yet. Okay, so it doesn't need to be something that you need to like do immediately. All right. So,
hey, Matt, I'll just chime in too that what we always had built into our operating agreements is a term for the buyout. So the value of your equity in the business can be determined by a third party, and there are multiple ways to arrive at that number. All of them hopefully leaning on expertise of an objective third party. But regardless of what that buyout number is, there's usually a clause in there that'll allow the company to pay back the exiting member over a long term, or longer than they would prefer, certainly, so as not to put an undue financial burden on the business and its ability to continue operating in that member's absence. And for the businesses I've been involved in, it's always been a 10-year term. You'll be paid out, the sum total over the course of 10 years. And so what that does is two things, right? It doesn't put undue financial burden on the continued operation of the business, but it also disincentivizes anybody from thinking that just by raising their hand for and volunteering to exit, that it's an automatic payday of any type that would get you excited.
Mhm.
I don't know if on the real estate side of partnerships it's the same. You could speak to that better than I could. Or if that would be, overly conservative.
Yeah, no, that definitely sounds reasonable. Okay, so Mike Fresco had some questions here. I'm going to just read through them and kind of address them one by one, and then any of you can chime in with your lived experience on capital raising, especially from passive investors, because this is going to be germane to that. So my questions are more around the specifics for partnerships and real estate deals, in particular in a situation where the partner puts up all of the funds. What is a reasonable interest rate for their at-risk capital? Okay, for their risk capital. What is the equity split? I've seen some partnerships where the equity split flips to the general partner, which would be like the person who's running the deal, the managing partner of the whole of the whole thing. Once the real estate capital, what's the risk capital is paid back. I'm also looking to possibly partner with friends and family to provide capital and absolutely want to make it fair and beneficial to all. So how do you set up GPs versus LPs? Okay, so kind of going down one by one, and as what is a reasonable interest rate for the risk capital? This has changed throughout the years, and this is the reason why the number one type of content that I consume is not necessarily real estate content. It's financial markets content. One thing is that because of the investors that I have relationships with are well-to-do, either high net worth or semi high net worth individuals. A lot of those individuals are like, they read the Wall Street Journal every day. They read the Financial Times. They read Barron's and Investors Business Daily and that sort of thing. So being able to communicate with them and not just the vein of just real estate, but also commenting on just like geopolitics and geoeconomic stuff has allowed me to build earn their trust and also speak their language, right? So how this has changed really is, and where we're seeing that we're actually successfully raising capital for our deals is 10% right now. Back in, when I first started raising capital in 2016, 2017, I was offering out 7%, and I was like, it was no problem whatsoever. All right. But at the same time, interest rates were like, I don't know, it was like under it was like 1% or something like that, under 1%. So that's what it's changed, that's what it's changed to, right? So I don't know, we've been offering out 10%, and this is generally for private money lenders, okay? So that's what we've been doing in terms of like an interest rate. If you're giving up more equity, all right, more upside to a deal, perhaps you offer out, you can offer out less. Okay. And here's the important thing too, Mike, is that the only, the first phase of this for all of you who are starting their Go Bigger journey is just canvassing your sphere of influence, letting them know what you're up to next. I'm hey, the next year I'm looking to buy a multifamily property, 10 to 50 units in the greater Minneapolis area. If I found a deal I really liked a lot, would you like to hear about how you might be able to participate? Okay, you might get questions that of like, well, what do the returns look like, and what do the equity splits look like, and all this sort of thing. The beautiful answer to the question is like, I have an opportunity yet. So, and every deal could be completely different. So, but when I do have an actual live opportunity in front of you that we have under contract, I'll present it to you at that time. If you like it, then we can do something together. If you don't, then I'll present the next opportunity to you. So, Mike, you had your hand raised.
You kind of touch on it, but yeah, so I'm getting that question. Like I'm meeting with people from business school, and and they're not pressuring me, right? But they're like, well, how are you doing deals? And I say that, right, because it makes sense. You can't, every deal is different, which of course I think they understand. But also in the back of my head, and the way my brain works is I don't even know what would be fair to offer. Like, I have zero problem with offering equity. That's fine if it gets me in a deal, no money down. Hell, of course, right? Of course, I'm going to do that. And what's, to get at their friends, not trying to, offer something that's, unfair to them or me. I don't even know without having the deal, industrial deal or commercial under. So that's kind of where my brain works. But yeah, I'm getting that question, and I do give that answer. But I also kind of want to know the answer too a little bit. Like, is it 70-30? Like the deal I was talking about, I was offered as an LP, like it was 70-30 GP. Then once all the money got paid back, it flipped to now I was 30% and 70%, which, I wouldn't anyway. So that's right. It's a lot of ways to skin a cat, right? But just all those things I'm trying to kind of play out.
Yeah. No, yeah, Mike. I mean, and this is the other sort of like discovery question when you have those questions of like, well, what type of returns and what type of splits and that sort of thing. I answer the question with another question. I was like, well, what's important to you? Like, are you interested in like cash flow, predictable, guaranteed cash flow in a deal, or do you not care about cash flow and you're looking for more like, the tax benefits and, and upside in a deal? Okay. If you were to choose, if you could only choose one, okay. Because this is where I categorize those partners in two buckets, right? Equity partners and private lenders. Okay. So if they say, yeah, Mike, I mean, I'm getting 3.75 on a money market percent of money market account right now. I'd be happy with something like above 8%, like guaranteed, right? Because even sophisticated financial people that may not be sophisticated real estate wise, they hear real estate and they think passive income and they think cash flow. Okay. Just predictable cash flow because I mean, how many of us that actually own and operate real estate can say, oh, I know, unless it's like, triple net lease stuff that's like, oh, it's just predictable cash flow. Okay. It's unrealistic. Right. So that's like the question. That's the question that I would answer that. It's like, what's important? Like, what's important to you? Because what I don't want to do is I don't want to start talking about numbers. First of all, they're going to remember the stuff that you don't want them to remember, like on these hypotheticals type of things, and then they're going to forget about all the stuff that they should remember. Okay. So I always like to present an opportunity when it's like when I have a deal and now it's like presented to somebody that's like fresh in their mind. Because a lot of times like these, people just aren't going to, one thing I can tell you for sure is people do remember numbers. Okay. Especially sophisticated financial people. I was at a presentation with our development consultant for some residential redevelopment deals that we have with one of our partners, and they were talking about the project level returns on this deal being 40% annually. Okay, this is project level, not investor level, and so this guy was sitting there and hearing 40% annual returns. And then at the project level, right before we're involved and we talk about equity splits and that sort of thing. And then when we actually had hey, we broke this thing down. This is what we're thinking about offering out to the ownership group and that sort of thing. And they were we were offering out to them where they're going to earn 19% annually. Okay, over the holding period. They're like, well, I thought this was a 40% deal. I was like, I would have done that all day long. I was like, well, listen, man, it's 40% of the project level, but based upon all these other things, the other people involved with it, it's 19% annually, right? And even after that, he was like, yeah, I don't know, 40% sounded great. I'm out. Okay, even though 19% is like a fantastic freaking return. Okay, so that's the reason why I'm like hesitant to like go into specifics because. You may present a few opportunities to these people that it just isn't their cup of tea, Mike. And then 4 years from now, you have an opportunity that's it's in a completely different interest rate environment and everything. So that's the reason why I like to, like, just say, yeah, are you interested? What's important to you? And that sort of thing. In terms of limited partners and general partners, I don't know if anybody in this group has done a limited partner, general partner type of, like, ownership group. Okay. Because the deals that we're doing in this group are generally between $1 to $5 million. And when you're doing a deal that's $1 to $5 million, you don't really have the economies of the scale to set up like a full, like, general partner, limited partner, syndication as part of the whole thing. So there's so many things that can be customized in the operating agreement that have the spirit of a general partner, limited partner type of arrangement. We really don't need to do it for the sake of this. I don't know. Is there anybody in the group here that's done a general partner, limited partner like type of setup? Not even you, Vlad?
No,
Okay.
because I
I'll
call
say.
limited partners lenders, not limited partners. I don't need limited partners.
Yeah.
That's the difference between a lender and a partner.
Mhm. Yeah, but like Mike, for instance, all that stuff that you have in there where you have you're giving up, I don't know, whatever, 70% equity. I don't think that for smaller deals sub 5 million, 50 is really the max that we'll do on those types of deals, right? So I don't think you ever need to go to 70 30, unless you were like dealing with like somebody who's an absolute whale, 8-figure, 9-figure type of wealth, that you're like, you know what? I'll take 30 of this on this smaller deal that might be $2 million, because this person is gonna allow us to bankroll up to 20, 30, 40, $50 million deals. So I'm happy with my 30%, even though it's not that much on this first deal. But if we can actually scale this thing, and then I have this one person that could completely eliminate all of the balance sheet bottlenecks that I could have doing on my own, all of the capital requirement bottlenecks, then that can be completely worth it, right? And then you could have something in your operating agreement is that once this person is paid back their risk capital, and with all of the interest that you have, or whether it's interest or a preferred rate of return, okay, which is kind of the same type of thing, then you can have it spelled out in the operating agreement that, hey, you get 70% this whole time, and then once you get all your capital back plus the interest, then we flip it back to we flip it to 70-30. All right. You can do that. And then Mike, I think also did I answer the first part of your questions
Yeah,
there?
no, that helped a lot. I just, yeah, like I said, I've seen some deals, and again, talking to people, and just to give me a framework of what, even in the back of my head, to help me talk about it, right? To kind of have an understanding of what is feasible. It's funny, I'll just say, I know we're at time, so the fact that no one's done a GPLP, that's literally all deals I've ever seen. Even on smaller deals, that's how they've been pitched to me, and mostly because the person wants to have all the control as the GP. But I agree with Vlad, like LPs are just lenders, right? Like that, so that makes a ton of sense. But that's just all I've seen. So I appreciate that insight from you all.
Yeah, no, absolutely. And I think that nobody raised their hand, and I think that we have, I don't
Yeah.
know, maybe
Yeah, it surprises me actually.
maybe
Yeah.
250 years of experience or more in here. So, and then what I was gonna say here. So the equity splits, right? So this kind of goes back to one of things that Daniel touched on, is a successful partnership is always dependent upon really everybody being interested. And what I mean by that is that when I put together an ownership group, I always want there to be enough to keep everybody interested, right? All of the partners, interested. I think the most dangerous thing that I've ever done is that I brought on a partner that for an active role, a pretty active role in a business I used to own at 10% ownership. Okay. Boy, oh boy, did they lose interest very fast. in the business, because they had no money. And then when it came to actually putting money, just like Daniel was talking about, like they didn't have any money to put in the business. Structurally, from an income expense standpoint, there was like, there wasn't any like way to get out of the hole besides just putting money into there. So then after making a numerous amounts of partnership loans that could never get paid back, I was like, listen, I'm gonna have to dilute you down, right? So now, the guy's at 5%, right? So that being said, I think that anything that puts you at 50% or above, I think is a win. All right. And the other thing that I do in terms of a partnership is I always go into this with the spirit of, hey, we're going to do, hey, we bought a deal. Now we're going to buy, we have a deal under contract. Let's find the next deal. I do it from the standpoint of like, could I see some duplicatability here? Could I see, am I getting into this? Is like, I don't want to do just a one and done partnership, right? Because then you have the partnership returns and the K1s and all this other, compliance stuff that happens when you actually have a partnership in place. I always want to do it from the spirit of, hey, we're to do one deal, and then hey, if it goes well and we like working together, then we're gonna do deals 2, 3, 4, and 5 and whatever. Okay. So I'd rather have what is it 10-20% of a watermelon than 100% of a grape. Okay. So those equity splits there. So some formulaic stuff that I have done from some equity splits that I always typically use is some deals I put together where I've brought in what's called a balance sheet, like a balance sheet partner. Okay. Like, let me back up a little bit. So there's some deals we've done where there was a building that we bought that was for $1.5 million. It was not going to cash flow, okay, for the first couple of years because we had to lease the property up. It was 50% occupied when we bought it, so we needed their interest deferred, okay, for that time period. So the way we worked it out is we offered them 9% interest on their money, $1.5 million, and 19% interest, membership interest in the holding company for the deal. All right. Why 19% is because typically speaking, most banks will not require somebody who owns 19% or less than 20% to be a personal guarantor on on a mortgage that you put on the property in the future. Okay. So that's kind of like the 19% rule. And typically this individual is very, very wealthy. Okay. And does not want to sign personally on anything. It's like a complete non-negotiable for him. So that's kind of like the 19% rule when you're dealing with somebody who's like, got a lot of funds, is putting into the deal. I'm happy to pay them, a generous interest rate. Because at the end of the day, equity is expensive. So now there's some deals that I've done where I needed to bring in an additional partner because of their balance sheet, right, and their liquidity. Okay, and balance sheet meaning because of their net worth and their liquidity. So in that case, they're gonna have to be above 19% interest because they're gonna have to be a personal guarantor. So I've negotiated deals where that person who's providing all of the capital and also the personal guarantee that gets the deal done, 35% of the deal. Okay, and then we run the deal. We run the deal and are managing members of it. But I don't know, Mike, if that makes sense. I don't know. Does that kind of answer your question?
Oh, yeah, thanks. And like you said, I don't have a deal yet anyway, so it all depends what the deal looks like. But that helps. Yes, thanks.
Yeah, no, it's like you can still talk. You can still talk to people. I mean, I know that people want to they get asked the question, and that is a good question to get asked. Oh, well, what type of returns? What are the equity splits? That means those are questions of somebody that's actually interested. Okay, I'm more concerned if they don't ask those questions. All right, but the way they respond to them is simply that, hey, listen, I'm out there making offers. Every deal is completely different risks. Different types of business plan. Like every deal is different, and I just don't want to. They could every return profile can be different. So, but if you're really interested, I'll present it to you when I actually have a live one on the hook. And typically that's been enough to sate that question.
Yeah.
Anybody else have anything to add before we wrap it up for tonight?
Well, I just asked, sorry,
Oh.
if anybody has like sample operating agreements that I like to read that stuff. I'm a lawyer. I'm kind of weird, but
yeah,
if you have some of those, then, I'd be happy to take a look, and you can scrub them, of course, privacy, but yeah.
Yeah, no, I'll send you over a couple of mine. So, and here's the thing too, is that besides the one that's between myself and David, every one of them has been different, because everybody else has their own attorney that operates that looks at it, that has their bugbear about something, right? So anyways, we'll see y'all next week, and then I know William Pape, you're driving right now, but hit me up sometime tomorrow, okay? Let's catch up.
Matt, I had something to throw in real quick.
Yes, James, go ahead.
I have last minute challenges on this deal, and I'm potentially looking to raise some more capital depending on what the owner's answer is tomorrow, because it's wishy-washy, and I might have the opportunity to take him out of the deal, but I also, if I don't, I might have to raise some capital at some point. So if anyone's interested in hearing about that, get a hold of me sometime tomorrow. If anyone has some capital to deploy.
Yeah, it's a 30 unit apartment deal. And then what's the potential need conservatively you're looking for to get this across the finish line?
It depends on which way I go. Maybe 100 and maybe as much as 3.
Okay, so 100 to 300,000.
Mm-hmm. Yeah, not a heavy ask, and it's a 10-month term to refi, and I think I already have a pretty good path forward for that. But the owner is holding back, and I may be able to take him out. And if he's holding paper on the down payment, and I may be able to take him out. And one way or the other, I gotta do something in the next day or two. So if anyone's interested, get a hold of me tomorrow.
All right, sounds good. Yeah, if anybody doesn't have James's number, let me know. I can introduce you guys.
Thank you.
Okay. All right, everybody.
Have a good night.
Yeah, you too. All right, everybody.
Thanks,
Peace
everyone.
out, and we'll see you next week. Okay. All right.